Well, g'day there, traders and friends, market enthusiasts right around the world. Once again, you are here with James on behalf of Pivot Point Trading as I sit down as at the close on Monday, February 22nd, 2016. The Dow Jones Industrial Average today had quite a nice rally up close to 1.5%, up 222 points on the daily chart. You can see right here a very nice looking almost a Morobozu type of candlestick. We do have that lower or that shaved upper limit. You can see that little wick on top of the candle. But all in all, it was a very bullish day. It closed very close to the highs. However, as I look at this chart and continuing on from, I guess, the pre-market update, which I warned people about, there is limited upside in this market. And I'm just simply telling you what I'm going to be doing right around these levels. Obviously, we had this little trigger here at 16,594 to say, look, if we break above this, we're breaking above short-term resistance levels, both in the month of February and also January. And we've really got an upside target on the Dow Jones Industrial Average, really up to the 200 simple moving average. This puts us in at around 17,250, give or take a couple of points from where we're currently trading at. If we just round down the current types of levels down to about 16.6, we're really looking at about a 600 point advancement at most with the upside potential on this market. In the grand scheme of things, when we look at that and really break down risk and reward in terms of our longer term positions, ever since before we saw the breakdown in August, we were preparing to short this market, and that worked out really nicely during this waterfall sell-off. And again, since the most recent lower highs, which established themselves in late October, early November, again, we've been selling short this market from 17.6 and most recently 17,126 when the macro support level broke again. So 3 out of 3 times since the market peaked in the month of May 2015 for the Dow Jones Industrial Average, we've really been timing the longer term types of hedges on this market. They've worked out incredibly profitable. I'm still holding them. And this is just an update to tell you, hey, this is what I'm doing and how I'm going to position myself for what I believe to be the final rollover, which we're going to see on the Dow, the S&P, and the NASDAQ when it finally occurs. When this rollover does occur somewhere within this red box, expect the January and February support levels, the macro support levels, which have held not only in the year 2016, but also during that August waterfall sell-off in 2015, and also going back into 2014 as well, the beginning of 2014, January, February, this support level to finally break. When we see that support level break, that's where panic and capitulation will flow into this market. This is nothing more than a counter trend rally, unfortunately. So although the volume hasn't updated on my screen as at the current juncture, it will update in about 30 minutes or so, but I wanted to put this video out there. I just want to say once again, just to update everyone out there around the world who follows financial markets, that again, when we were bottoming out down here, the actual sentiment and the psychology of people trading the market was extremely bearish. We got the hint that the market was set to reverse with this particular candlestick. I put the update out that very instant day, or that same day, pardon me, and since then again we've established this little double bottom, what people are unfortunately calling a double bottom, and since then the discourse or the narrative on the market has changed from complete and utter bearishness to more or less euphoria as per the past rally which we've seen take place over the past 6 trading sessions. Now again, it's great to see the market rallying again up 222 points today, but this is nothing more than a counter trend rally. I want you to understand this. The primary trend is what is most important with financial markets. So since that low in 2009, we've obviously been in a long-term primary bull market. Now that has ended as at 2015 when we saw the long-term primary trend breakdown. This was the third fan line extension. So we had the first one again, as I referenced in the pre-market on Monday. We had the second fan line, which broke in the year 2011. And since then, we've been in that third extension. Fan lines generally work in groups of 3 until the market is moving sideways. And then ultimately, it'll break the third fan line. That's what we saw in August. So I'm zooming in once again on the weekly candlestick chart right here. And what we've done is we simply come back up. We've back tested the primary trend line. It's now acting as resistance. And it has established the new bearish trend, the primary trend of the market. So just like we saw post the August lows when we saw the intermediate correction back into the primary trend, this is what is repeating itself right now as at or on the Dow Jones, the S&P, and the NASDAQ. So when we look at upside potential, sure, we can say, look, the 200 simple moving average is a really good expectation. But having said that, we can push it up a little bit higher. What you need to understand right now, and I'm going to stop moving my cursor and just explain this to you. The bears are in control of this market, and they will remain in control of this market until we break above the declining primary trend line. That right now is coming in at around 17,500 to 17,600. If I change back to the weekly chart, I'll explain this to you. I'll show you this. See this trend line right here, which is connecting all of these most recent swing highs. If we extend this out into the future, that's what this red line is on my screen. You have to understand that the bears are in control of this market unless we break above the primary trend line. And even if that occurs, we still need to break above the all-time highs on the Dow at about 18,300 until we can become, once again, longer-term bullish on the overall health of this market. There are a lot of warning signals, a lot of cautionary signals in terms of technical analysis, again, establishing consecutive lower highs and most recently macro lower lows. We've got all sorts of divergences playing out. We've got long-term monthly MACD sell signals with a lot of oscillating indicators as well. And the chart patterns themselves are very, very bearish. If I zoom out and show you this, I was speaking about this over the weekend in Pro. I mean, in terms of a reversal type of signal, just say, for instance, this is the left shoulder, and then we've got a multi-year head over here. I'll just put a H here. And then when we look at the construction of what we've seen since August all the way through to February 2016, it's looking awfully a lot like a right shoulder over here. Let me just do the right letters right here. The right shoulder over here. So again, the neckline of this chart pattern is establishing itself really around 16,000, but just to be safe on the next retest, you really want to put it below these three little swing lows over here. Having said that, again, if you look at the trend direction, it is clearly down, much like a lot of individual stocks and at least the broader sort of look at financial markets. If you want to pay attention to the Russell 2000 or even the transportational average, they are simply going back or repeating the sort of the movement which we're seeing in the industrials, where we're looking at counter trend movements back into areas of resistance which once acted as support. If I have a look at the Dow Jones Industrial Average, if I had to take a guess of where this market is going to turn, it's probably going to be about 17.1, if not that psychological round number around 17,000. That mirrors up very nicely with the S&P 500. You can see this macro support over here, which held in October. It also held in November and twice in December before ultimately we broke down at the beginning of 2016. This old support level is now going to act as new resistance. That puts us in at about 2,000. So here we are as at the close on Monday at 1942. So we're saying to ourselves right now, look, we've got about 58 points of upside potential. Today we saw the S&P rally 24 points. So I mean, it's really only 2 more days or 2 similar types of trading sessions to what we've just seen today. And then there's a very good chance that that will be the high, or at least the next lower high, which the market puts in across all 3 of the US markets. The only one outlier to this discussion is the NASDAQ. And the reason for that is because we still have open gaps. Now, open gaps generally try to fill, right? Most of the time, to a high degree, the gaps or open gaps in a market will fill. And 5,000 is a very good level on the NASDAQ. You can just see it's disproportionate to the types of levels which we're looking at on the Dow Jones Industrial Average and also the S&P 500. So again, this isn't going to be, or it most likely will not be, a reversal which happens on a dime. It's probably going to, again, come back up to around 17,000, and we're going to go through some form of a double top process, which may take about a month to play out. And then we'll build the structure. And then ultimately, when we see the neckline of that pattern tend to break, that will be the final opportunity to really position yourself for this market rollover. Again, you have to fight temptation right now. The easy way out in this market is to buy into the complacency, to buy into the optimism, and to really just buy into the hope of this most recent market bounce. It has been a lot to do with short covering taking place on very low volume. So the majority of people aren't actually buying this bounce, and in fact, institutional investors are actually using the bounce to distribute their longer term positions as well, and using it as an opportunity to offload a lot of stock and a lot of shares which they're holding to, again, Main Street, or sorry, what I should say, Main Street, people who are buying into this rally. So things are looking very ugly in this market, even though the Dow Jones, again, had a pretty nice day up 222 points. As it stands, if I change to the exponential moving averages, I've mapped out personally what I'll be doing and how I'm going to play this bounce. Again, the bounce is something which we've been expecting for a number of weeks now, really since this one particular candlestick. Again, the net movement to be up in a very ugly fashion. That's exactly what has happened. We saw this first bounce, the failure, and then again, the double bottom, which a lot of people are referencing. Unfortunately, it's not going to hold. And now we've technically broken above the resistance high at 16,500. Now, Again, long term, I'm not buying into this market. Otherwise, I wouldn't be positioning myself short. But what I've said to people over the past and throughout Pro at least is to say, look, once we break above the 50 or get close to the 50, this is going to be a fantastic opportunity if the market rolls to position yourself short. So I, to myself, and being truthful to myself and people in that class, I've started to once again add to my short-term position. So once again, as I was creating a position over here pre the August 2015 breakdown, again up here at 17,633, I've added to that position. Once again, I've added at 17,126. Now I'm adding again right now at 16,594, knowing that, of course, the market can push on up a little bit higher. I'm full aware of that. But what I don't want to do is to be a trader or someone following this market so closely to miss my opportunity to short it, trying to get the best possible price. I'm not going all in at 16,594. I'm nibbling on small positions, and every point this market continues to move higher, all the way up to about 17.4, 17.5 at a maximum, really to where this primary downward trend, this is the upside potential, more or less in this red box over here. So what I'll be doing also, we'll be paying attention very closely to the declining 100 and the 200 simple moving averages. So really the update this week, or as at the close on Monday, is to say that, look, I'm selling in the face of strength. All right, just to sort of conduce it into a sentence, I am opening up short positions in the face of bullish strength in this market, knowing all well and good that I am early in this market rollover, but I don't want to be late. I'd rather be early, position myself short, than be late and miss out on the actual rollover itself. All of this movement higher is going to fizzle, and when it does, we're going to see these lows break. And every position you take up and around these levels, of course, you have to make that decision for yourself, is going to be, in my opinion, rewarded very, very handsomely when in fact this market rolls. Now, over the weekend also, I spoke about in terms of time frame, how long this can actually last for, this bullish rally, and we came to the conclusion that it can really last anywhere up to 8 weeks. So don't think or don't feel as though this is something that you need to jump into on Tuesday, or you need to jump in at all. Obviously, you need to make decisions for yourself. But really what I'm just trying to suggest is that, look, we usually come back up and retest that 200 simple moving average. And on the weekly chart, there's a very good chance, this is the weekly chart with the exponential moving averages, there's a very good chance we come up to the 50-week exponential moving average. That puts us in at 17,072. So again, on the upside, we're looking at about 400 points. So again, just under double what we saw in today's market action, being Monday. All right, so just think about that. We've got, all of the lines are coming in at around 17,000, much like I was sitting here in the month of October and September saying that, look, we're expecting the slope of hope rally to establish itself. That's exactly what happened. But then we came to confluence, and what I mean by that was that there was varying levels of resistance. And what I mean is that if we connected these three peaks over here and we projected it out, we said, look, this is a really ideal opportunity for resistance to build on top of that. Prior to the retest, so the breakdown and the retest of the primary trend line, we were just dealing with the actual extension of the trend line itself. And that extension, once again, you can see over on my screen, just imagine that this price action wasn't here. If I just cross it out for you, you can see that these lines over here came to a point, and it was sort of saying that, look, X marks the spot. And that's exactly what happened throughout the months of November and December. X marks the spot. You can see it perfectly on my screen right here. What I'm trying to say to you right now is that X marks the spot right here on my chart. It's sort of like digging for treasure, right? We know roughly where a turn will take place, if in fact it's going to, and I'm positioning myself right now accordingly to take advantage, unfortunately, of this turn. And if this turn does happen once again, there is very little chance that you're going to have an opportunity to hedge yourself at these levels which we are currently trading at. This is really trading at a discount in terms of a hedge for technical swing traders. And there's a very good chance that once this level fails up here at 17,000, that we won't revisit it for a very, very long time, especially if we see the macro support breakdown here at 15,500. So I just wanted to update you as at the close on Monday afternoon. Again, just to conduce it, I'm selling into the face of market strength. I don't want to be late. I'd rather be early, knowing all well and good that the technical signals are long-term bearish, and the market itself is really trading on a discount, in my opinion, for 2016 as to where, or in conjunction or in counterpart to where it will be trading later in 2016. So I'd rather have a position open. Of course, I'm working with very strict risk and money management rules. I'm not going overboard on these positions, but I'm intelligent enough to be taking on counter trend trades, or at least trend trades, the primary trend directional trades, even though that the intermediate trend is moving back up into the correctional type of movement, which is in conjunction with the downward primary trend line. So just think about that, everyone. If you have any questions, write them in the comment section below. Outside of that, have a fantastic week. I hope this was educational and informative for you. If you are watching these videos, let me know. If not, I won't bring you these updates. But I think people need to know, obviously, what's happening in the financial markets, because it is a very important time. And if this level fails up here, I'm telling you, it's going to get ugly. It is going to turn very, very ugly. And this is just a straight up disclaimer right now, an informative disclaimer saying, look, if this happens and if you see the reversal signals take place, it's not going to take place this week because we're just seeing the breakout. But if we see it over the next within the next 2 months, this is putting us in the time frame of April. If we're up here in April or up here in mid to late March, and the Fed's due to speak in March, and let's just say, for instance, they don't do a 180 backflip on their interest rate policy or on their monetary policy, and say, for instance, that they don't sort of loosen their monetary policy in terms of QE. Let's just say they don't formally, recommend or at least say that they're going to go down the path of more quantitative easing. Well, again, I feel as though that's really going to disappoint market participants, and that may be the catalyst for, once again, this bear market continuing in the equity market. So it's just something to think about as we move forward into March 2016 as well. Outside of that, everyone have a fantastic week. Again, a lot happening in financial markets. Please stay in check with the markets. It doesn't mean that you have to trade them or be active, but just understand that this red box on my screen is absolutely critical. And if you start to see reversal signals anywhere in this screen up to 17,000, up to 17,500, you need to make some very serious decisions or have a very serious discussion and say, what am I going to do about this in the face of potentially a very sinister 2016? All right, everyone, it's James signing off on behalf of Pivot Point Trading. Have a fantastic week. I'll be back with more market updates. All the best. Goodbye.